Hey everybody, welcome to this week's video. As always, we'll be covering the datasets, the earnings, and the SPY technical analysis for the week of August 17th, 2026. Now, I still am working on my streaming schedule, but we are starting to get the AI going. We're getting the server up this week, so I'm very excited. Hopefully we can get that out in the next 2 to 3 weeks. We'll have to see though. But anyway, let's go ahead and jump right into the data. Now, I'll just preface this, but we really don't have a whole lot of important data this week. If anything, it's probably going to be the FOMC meeting minutes from Wednesday or the S&P Global Manufacturing PMI on Friday. But let's go ahead and just quickly go over it. So nothing major on Monday. On Tuesday, we have the housing starts data. That's something we really don't have to focus on right this moment. Now, the housing data in general, you don't have to focus on too much unless you're starting to see the labor market crashing. Um, then that starts becoming an issue. Okay. We have the industrial production coming out at 9:15 that day. That could be somewhat of an important data set, but usually that doesn't move the market too much at all. So I'm not too concerned about Tuesday overall. Now for Wednesday at 2 p.m., we do have the FOMC meeting minutes. This is again from July's FOMC. Now, I'm really not anticipating a lot out of these meeting minutes. More so, it was the June meeting minutes that I believe were more important. And the reason why is because out of this meeting, yes, it was, I don't want to say it was indecisive, but moving into the FOMC was indecisive from investors, from that investor standpoint, watching the CME being, heavily skewed to the odds of a rate hike. Um, that was the indecisive part. But as the actual FOMC members, we only had two dissenters this time. So that's been gradually dropping each and every meeting. We also see that, the data sets have been coming in much cooler. So I really don't think these meeting minutes are going to tell us a whole lot, other than they just want to see a pause. So Thursday, we do have the Philadelphia Fed Manufacturing Index that can put some weight onto the market overall. And if the initial jobless claims comes in hot or cold, that can definitely shift the market sentiment quite a bit. But it's been holding this level for quite a while, so I'm not really expecting any major shift in that just yet. Now for Friday, we have the S&P Global Manufacturing PMI, the Services PMI, and the Global Composite PMI. Not really too concerned about these. They absolutely can move the market, but again, it's just not something I have a major concern about. Now, jumping into the earnings for this week, I'm not really interested in any of these. The only one I'm really interested in is Target, just because I like to hear what's going on with the consumer base on the ground, meaning not some tech company, not something massive like that. I want to hear from companies like Salesforce, Target, Walmart, McDonald's, these companies that have a lot of front-facing interactions with their customer base. They really do tell us a pretty major story overall. So that's important just because of that. I'm not trading Target right now. And then Alibaba can start becoming a little bit of a earnings to pay attention to. They've been investing a lot into AI services, so I haven't read the full scope of that, but I do think that the Alibaba group can definitely be an interesting earnings. The rest of them, I'm not too interested in at all. And before we jump into the technical analysis, I do want to talk about the Fed CME watch. Or I said that wrong, the CME Fed watch, excuse me. So, as you can see, just going over the last couple months, and this is for the odds of the September monetary policy, okay? The odds have massively shifted. Just a month ago, during the same time when we were having last month's FOMC, this was almost a 50-50%. And even with it not being 50-50%, there was a 5% chance of a double hike by that point. Okay. That double hike has been canceled out, and it was still pretty close to that. It was skewing a little bit more towards the pause. And then over the last couple days, last week especially, we have seen this shift massively to the odds of having a monetary pause. Um, That's something I heavily expect. And let's just go ahead and look at December here for a second. We can see this going through December where the pause odds have gone, quite high. They were at a 25.9%, dropping to 22.9%. Now it's all the way up to 32.4%. So very massive odds there. And the odds of additional rate hikes above where we're seeing right now has just dramatically dropped. Might seem small, like a small percentage when it's at 5%, but that's saying for 3 rate hikes. Okay, for 3 rate hikes, there was a 5% odds. Now that's down to 2, that's going to drop off to 0 very, very quickly. For 2 hikes, it went from 24.4% down to 19.8%. Okay, once we get through September's meeting, if we have a pause during that meeting, then this is going to drop drastically. Okay, and the odds of the single hike have been fairly close because again, the pause and the hike are going to remain fairly close because we still do have an additional 3 meetings this year. So the market is still pricing that in currently. Um, but these odds are shifting massively towards almost not having any rate hikes at all for the rest of the year. May not be entirely that yet, but the story will be continuing to change, and I'm sure unless there's anything um, that I'm not considering within the scope, that we very likely will be seeing monetary pauses for the rest of the year. And come 2027, very likely we will start to begin to actually start pricing in rate cuts rather than rate hikes. So I'm interested about it. Sorry, I can't talk very well today. But I'm interested about it. I think it's very interesting to see, and it's a very, very shifting market, as I've been kind of talking about the last couple weeks now. But we're really seeing a massive shift in the market, and this was almost like in 2023, 2024, back in either October or September. I don't really remember which one, where we went from this sentiment of basically potentially we have rate cuts on the table to no, we're going to have to pause the rest of the year to all of a sudden, oh, we need to actually have rate cuts. Did I say rate cuts or rate hikes first? Should be rate hikes into pauses into rate cuts. Okay. Um, no, I don't believe we're going to get a rate cut this year. I think that's entirely out of the scope of what's going on right now. But this is a big reason why we saw the rally during that time, was because the market was massively shifting. And we're starting to see that again. So definitely stay on your toes, but this is telling us a really good picture for, um, the odds of the monetary policy being held for the rest of the year and moving into rate cuts in 2027. Trading is a skill that can last for a lifetime. Join my Patreon for live classes, my personal market analysis, premium Discord access, and direct communication with me. Invest in yourself, become a more consistent trader, and build a better future for yourself and your family. Visit patreon.com/wooksy to join today. Thank you so much, and let's return back to the video. Alright, in this week's technical analysis for the SPY, we're at a pretty tricky point right here. Okay, and I'll get into why in a minute here, but let's first go over our Bollingers and moving averages. So the Bollingers started to expand again, and that's showing higher volatility. Volatility doesn't always have to just be selling within the VIX. Volatility just means very large movement within the prices. Okay, we went from that lower Bollinger all the way to the upper Bollinger, and that's what caused that massive shift in the Bollingers expanding. Okay, the price is starting to expand above our range. With that said, we did have that very bullish upper Bollinger move. We did pull back from the upper Bollinger, we did retest the 5 MA, and then we've been really kind of heavily consolidating around that range. Now, I know some might say that, oh, well, we've still been pushing all-time highs. Absolutely, I'm not going to disagree with that, but we've been sitting between this, basically this very, very high 768 to all the way to the 779 range. Okay. Um, Very, very large consolidation going on in there. Now, As of tomorrow, the 5 mile very, very likely will be around that 774.80. The current market price right now is at the 776.34. So if we see the 5 mile retested, we can start to push down to the 10 mile. 10 mile should be around that 771.50, give or take, on open tomorrow. And if we break that 10 mile level, then we could start looking towards potentially heading down to the 20 mile. However, if we retest the 5 mile and start seeing a bounce to the upside, then potentially we could start heading up all the way to the 780 or the 790, excuse me. Because as you can see, the upper Bollinger is accounting for that volatility to push us currently all the way up to almost exactly 790. Okay, it says 788.61, but that will expand on open tomorrow. And you have to remember that generally a push above that range is what the market tries to do when they're really trying to have a bullish push. So that would push us well above that 790 range. Okay. Now, a couple things to consider here outside of the moving averages on the daily time frame before we look at some structure is the ADL, and let's just go ahead and really zoom into this here. We've been pushing up on the SPY with the ADL moving downward. That means people are withdrawing money with the price going up. There's a divergence there. Okay. Another divergence is that, do you see the volume profile? Continuing to drop, continuing to drop, continuing to drop, even as we continue to push all-time highs. Very, very, very dangerous range to be looking at here. And it kind of does remind me of when we did hit the previous all-time high, where we did start seeing the volume descending, and it wasn't even descending nearly as bad as what we're seeing currently. So this is something to be concerned about. It doesn't mean that the volume can't pick up. Absolutely can. But I think the market's really waiting for some form of event, and I don't really see anything in the near future. The earnings this week are not anything to write home about. We're not having any major FOMC data. We do have the meeting minutes, but the market should shrug that off for the most part, unless there's some really dovish undertones in there or something else. But nothing's really here to push the market too much at this point. Now, that doesn't mean we're going to have bearishness either, which that kind of leads into this next portion, is that we are back within the consolidation channel. Now, these two channels, and we're actually going to swap to the 4-hour time frame here for a moment just to kind of show them. And all the lines, these are just support lines. The red is resistance, so don't worry about that too much right now. But we've been sitting within this consolidation channel pretty heavily, and we should actually at this point go ahead and pull that up now that we have once again rejected the buying channel. Okay, now we can continue extending this buying channel, so don't misunderstand that. If we continue seeing a push to the upside, then we will be extending that buying channel to the next major support. Okay, now however, we did break the buying channel before I just extended it, and as you can see, you know, we're definitely pulled through that range, and by extending it, I meant extending the consolidation channel. Um, but we're within the consolidation channel again, even before I extended that upward, is what I was trying to say. And with that, that means that perhaps the market really wants to build a base in this range. Okay, now here's a couple structures I'm looking at just from the get-go. We have the cup, we have the potential of the handle, and that can definitely push us upward. Okay, I think that's very viable at this point, especially when we're seeing descending volume and we're at all-time highs. Descending volume at all-time highs does not instantly mean we're going to start selling off. Okay. However, and this is the big however, is that we do potentially have bearish structure building. Especially if we stay within this selling channel, retest the 5-day moving average, start pushing downward, we absolutely can start seeing this head and shoulders playing out. And the head and shoulders playing out, again, has a lot of room downward. Okay, if we're really going to start targeting some of these downward supports, then there's nothing but room underneath it. So that's what I'm looking at for the structure. And this is something that you should be trying to watch out for each and every day. Before you do the trading session, go to the one of these larger time frames, either it's the 4 hour, hourly, or the daily, and start drawing out some of the structure and really making a plan of what you see occurring. Um, we're kind of in between structures right now, and that could be a little tricky because it can start looking like we're getting ready to pull down, and then all of a sudden we pop back up, create the handle on the cup, and we're good to go. Um, at the same time, we can continue forming that head where it might look like it's that cup on the or the handle for the cup, and then all of a sudden we get another gap down. Okay, and all of a sudden um, we're starting to have some selling again. So one thing that I really like to do, I know I've talked about this many times, is that when we're in consolidation channels, don't focus too much on what's going on with the structure. Focus a lot more within the channel because the channel is the structure itself. This top line is a resistance. This bottom line is a support. It is something you can rely on. Even if it doesn't trade exactly within that range, it still gives us a good guesstimation of what we should be expecting. When we got to the bottom of the channel, what happened? We started trading up to the top of the channel. We're potentially at the top of the channel right now. What's very likely going to happen? Start trading towards the bottom of the channel. Okay, and I think that's a very reasonable outlook right now to have, unless again we start seeing some, ravenous buying to the upside, which I'm really not anticipating just yet. I could be wrong, but nothing within this week's data, nothing within this week's earnings are really telling me that's on the table. So we're going to end the video there. I hope you all enjoyed. Thank you so much for watching. If you do like my content, feel free to subscribe to watch additional videos. And one thing that I do want to make a mention of is that on YouTube, with the bell icon, if you don't specify to show all videos, it's going to be very selective with what videos that it does show of mine. Um, Again, I do a video 5 days a week, and I put this weekly video out, and most people don't get to see it because it gets buried within, any of the big channels that they have subscriptions to or anything else. So if you don't have it basically turned on to where every time I post a video it's going to show, then unfortunately you're going to miss my take on the market, the recaps, the analysis, the things like that. So anyway, take care. Have a great rest of your Sunday. Let's have a great week, everybody. I'm still working on my streaming schedule, as I said, and the AI we got going is going to be amazing. So I look forward to being able to share that with everybody very soon. Take care, have a great week, and I'll talk to you in the next one.